Hello, this is Mike Wade and welcome to this video featuring Tom's Tools with Tom's Trading Room. Stock and options trading has large potential rewards, but also large potential risks. You must be aware of these risks and be willing to accept them in order to invest in the stock and options market. Don't trade with money you cannot afford to lose. I'm not offering any recommendations. I'm not a broker, nor a dealer, nor an advisor, and please don't construe anything I'm about to share with you as advice. All prices are in US dollars unless noted otherwise. And of course, feel free to read the balance of the disclaimer at your leisure. It's May the 9th, 2019, and as of the time of this recording, the markets have rolled over. The last 4 days, we've had some really big 1 to 2% down days, a lot of whipsaws, a lot of volatility. The markets look poised for a downside movement. So what do we do with this? Well, let's make money or protect ourselves. I'm going to show you how to do that with a calendar spread. So what we're going to do in this video is we're going to do 3 things. We're going to look for bearish candidates using out-of-the-money calendar spreads. I'm going to talk about the impact of implied volatility. And then lastly, I want to talk to you about how to manage out-of-the-money put calendar spreads. Let's talk about profiting in the bearish market using calendar spreads. And the type of calendar spread we're talking about is an out-of-the-money put calendar spread. Now, why would I use a calendar spread out of the money, and why would I use puts? Well, there's really 4 main reasons. One is that you have a higher probability of profit, and pound for pound, you get this potential profit for a lot less money than most strategies. Typically, we spend less than $1 a contract, and that lowers our risk in the trade. So more probability, less risk. We also get smart about positioning a trade that has positive vega, meaning that if we're right about direction, implied volatility will likely increase, and that will put money in our position, profit in our position. And 4, calendars put time on your side, meaning they have positive theta. As time passes, that's a good thing. It actually puts more profits into our account. So it's really a smart trade. It's smart on direction. It's smart on vega, volatility rush. It's smart on having time work for you. It's just a really smart and elegant and sexy strategy to use in a bearish market. So this is the market we're in, and I'm actually thinking we might have another Q4 2018 scenario on our hands. And if I'm right, and the reason I say that is we've had 4 straight days of big down days, like 1 to 2% down days, a lot of whipsaws, a lot of downward movement, big volume as well. I'm thinking we could put a calendar spread down, way down here, perhaps around 260 or so, and profit directionally with a calendar spread and get all those benefits that I just mentioned before. So what we're going to do is we're going to use out of the money put calendar spreads and spend less than $1. Let's get into the tools and let me show you how you can find these things, because we have a scanner for it. You go to searchers, single strategy, and calendar spread. You've seen this before. You've seen this spread before. I've talked about this searcher before. And last time we used at the money put calendars. Now we're going to use out of the money put calendars. I want to use ETFs, REITs, trusts that have options, because none of those instruments have earnings, and I'm not interested in an earnings surprise moving the trade against me. So we're going to be using this stock list. You hit your search button, and then what comes back is a long list of potential out of the money put calendars. And notice on the top of the list, I know I'm scrolling a lot, but notice on the top of the list you have some really high potential profit divided by debit. That's return on investment. So you have the stock or the symbol, you got the closing price, the strategy, the strikes. We're selling and buying at the same strike, but different months. We're selling a short-term month, and we're selling buying a longer-term month. So you can see there on this first one, we're selling a June option and we're buying the July option. Strike prices are the same. We have our volume, our open interest, the actual legs, the difference in days between the short and the long option, the expiration dates. We have the debit being spent. This one's going to be $900. So this is a $9 spread. It is an expensive one, but we're actually going to be coming down here in a minute, and you'll see one for less than $1 or $100 for 100 shares controlled. You got your profit divided by debit, which was return on investment, IV, skew, and sell by. So it's quite a bit of information there. Feel free to use the help files to dig into more of the detail. But really, what I'm looking at here is with the SPYs trading at 286.52, the scanners come back and said, well, you could put an out-of-the-money put calendar at 245, which is obviously less than 286, and I can do all of that for $97. And if I'm all the way right, I could potentially have a 797% return on investment. I'm very interested in that. To look at it, click either of the legs. Let's go take a look at this thing. Here you have it, a 97 cents per share controlled, or $97 for the entire shares controlled, to potentially make $777. That's a 784% return on investment potential. Notice that we've got our legs. We're selling a 50-day option, and this is the June 245 put. We're buying a 100-day option, which is an August 245 put. We're doing all of that for 97 cents times 100 equals your total debit, which also equals your maximum risk. So think about that. You're putting roughly $100 in to make $775 roughly, and it's a good deal if, in fact, you believe the markets are bearish. I do, and I think this is really a beautiful risk graph. Notice here that as the stock drops, currently the theta lines are showing profit. Over time, provided that the markets are down here below this break even, then theta turns positive, and you've just got a really big, super wide profit zone. And as time passes, the calendar spread kicks in, theta kicks in, and you're making money as time passes. And also notice that your vega is positive, which means that as this SPYs drop down, implied volatility already happening starts to spike up, and that also makes this whole risk graph move into profit. Really smart trade to use in a bearish market. So how do you manage these things? How do you get out of them, basically? I've told you how to get in, but you need to know when to exit. So certainly, if you've doubled your money, consider exiting, taking the profit off the table. Another smart thing to do is exit half and take the rest to expiration, or to the following exits. Exit if the stock closes above the upper break even. That means this stock is moving the wrong way, and get out. If you do that, you're not going to lose much money at all. So get out if the stock closes above the upper break even. And then as you approach expiration, when you get into the final week, consider exiting on the Wednesday before expiration. That is a good time to exit, and maybe sooner, maybe later, but somewhere during the last week, average 3 days to expiration is a good time to exit. So in summary, what did we do? We went into Calendar Finder and we clicked ETFs, REITs, trusts, optionables. We selected out of the money put calendars. We then selected search, and we went through the list, and I've showed you how to manage these things. Really smart, apropos option strategy for you to consider in these current bearish market conditions. All right, well, thanks for watching, and I hope you enjoyed the video, and I'll see you next time.